Do you know what the most terrifying human trait is? It isn't greed. It isn't violence. It isn't even stupidity. It's our ability to forget pain. We are wired with a psychological defect called normalcy bias. When things are okay today, our brains physically cannot accept that disaster might happen tomorrow. We assume the cliff edge is miles away, right up until our toes are hanging off it. I've spent the last 3 nights not sleeping. I've been looking at charts that technically shouldn't exist. I've been talking to people in high-rise offices who are quietly packing up their desks while telling their employees everything is fine. And I realized something that made my blood run cold. It's happening again. The exact same setup. The exact same lies from the media. The exact same financial house of cards waiting for a stiff breeze. But this time, it's not subprime mortgages in Florida. It's not dot-com stocks. It is something much bigger, much harder to hide. And it is sitting right in the middle of every major city on Earth. And the scariest part? 99% of you watching this are completely unprepared for the fallout. Most people think a crash looks like a single day where everyone screams and jumps out of windows. But that's not how it starts. It starts with silence. It starts with a slow, creeping rot that eats the foundation while the house still looks painted and pretty. We are in that silent phase right now. And if you don't know what signs to look for, you're going to be the one holding the bag when the noise finally starts. Let's talk about the ticking time bomb that nobody wants to discuss. Commercial real estate. In 2026, we have accepted a new reality. Remote work didn't go away. AI is shrinking corporate headcounts. Companies realize they don't need 10 floors in downtown Manhattan, London, or San Francisco. We are living in an era of ghost towers. Office vacancy rates in major cities are hitting historic highs. 20%, 25%. In some tech hubs, it is pushing 35%. Now, I know what you were thinking. You're thinking, Ryan, I don't own an office building. I don't care if some billionaire landlord loses money. Let them go broke. And that is exactly the mistake they want you to make. Because you don't understand who actually owns that debt. To build that skyscraper, a developer borrowed hundreds of millions of dollars. They pay that loan back using rent from tenants. No tenants, no rent, no rent. They can't pay the loan. And here is the data point that keeps me awake at night. In 2026 alone, over $1.5 trillion in commercial real estate debt is expiring. This is what we call the refinancing cliff. These landlords need to refinance that debt, but they can't because interest rates are higher than when they borrowed the money 5 years ago, and their buildings are worth half of what they used to be because they are empty. It is a mathematical impossibility. It's 2008 all over again. But instead of a stripper in Las Vegas owning 5 houses she can't afford, it's a private equity firm owning 50 skyscrapers they can't fill. The asset is worthless, but the debt is real. And that debt is about to become your problem. Now, you might ask, if these buildings are worthless, why haven't the banks collapsed yet? Why does the stock market look fine? This brings us to the biggest scam in modern banking history. It is called held to maturity. You see, right now, the banks are sitting on billions of dollars of losses. But as long as they don't sell the bad loans, they don't have to report the loss. They are allowed to value these worthless assets at the price they bought them for, not what they are actually worth today. It is Schrodinger's bank. The bank is both alive and dead at the same time. They are playing a game of extend and pretend. Banks are looking at these landlords and saying, "Hey, you can't pay? That's okay. We will just pretend this loan is still good for another year. We won't foreclose on you, because if we foreclose, we have to admit the building is worth 0, and then we go bankrupt." They are cooking the books. They are hiding the losses. They are praying that interest rates drop or people suddenly decide to rush back to the office. But hope is not a strategy. We are watching a slow-motion car crash where the drivers are refusing to hit the brakes because they think they can phase through the wall. This financial rot is creating a phenomenon that economists are terrified of, but they won't say the name out loud. It's called a silent depression. If you look at the GDP numbers, the government says the economy is growing. If you look at the S&P 500, it looks like a bull market. But if you look at your bank account, you feel broke. Why is there a disconnect? Because the growth is fake. It is fueled by government deficit spending and credit card debt. We are seeing a K-shaped reality. If you own assets, stocks, houses, Bitcoin, you are getting richer on paper because the dollar is losing value. But if you work for a living, if you rely on a paycheck, you are getting crushed. The cost of insurance, food, energy, and rent has skyrocketed. The inflation numbers they show you on the news are manipulated. They remove the things you actually buy and focus on the things you don't. They tell you inflation is down, but your grocery bill is up 40% in 3 years. This is the psychological trap. They are gaslighting you. They tell you the economy is strong, so you keep spending, so you keep borrowing, so you keep the machine running. But deep down, you know something is wrong. You feel the vibes are off. That vibe is your survival instinct kicking in. Trust it. Okay, Ryan, stop fear-mongering. How does an empty office building in San Francisco or a lie on a bank's balance sheet hurt me in Ohio? How does a default in London hurt me in Texas? This is the mechanics of the crash. This is the domino effect. When the landlord defaults on that $100 million loan for the empty tower, who takes the loss? The bank that lent the money. But it's not the giant, too big to fail banks like JP Morgan. They mostly got out of this garbage years ago. It's the small and mid-sized regional banks. The banks where your small business has its payroll account. The banks that finance your local car dealership. The banks that hold your local municipal bonds. These small banks are loaded to the gills with toxic commercial real estate debt. When those loans go bad, the bank becomes insolvent. We saw a preview of this a few years ago with Silicon Valley Bank. Remember how fast that happened? In 48 hours, everyone panicked. In 2026, it won't be one bank. It will be 50 of them, all at once, realizing their assets are trash. When the banks lock up, credit freezes. This is the part that ruins your life. Imagine you run a successful bakery. You have customers, you have revenue. But you need a short-term loan to buy flour for the holiday rush. Usually, the bank says sure. But in a credit freeze, the bank says no. Not because your business is bad, but because their business is dying. So you can't buy flour. You can't make bread. You have to fire your staff. Those staff members now can't pay their car loans. The auto lender sees a spike in defaults and stops lending. Now nobody can buy cars. The contagion spreads from the empty ghost tower directly into your living room. The economy seizes up because the gears are clogged with bad debt that nobody wants to admit exists. And there is a new variable in 2026 that wasn't there in 2008. Artificial intelligence. Usually, when the economy crashes, it bounces back because companies need to rehire people to do the work. But this time, companies are using this silent depression as an excuse to replace humans with software. We are seeing it in tech, in media, in customer service. They aren't just firing people to save money for a quarter. They are firing them permanently. This makes the ghost tower problem worse. If a company replaces 500 accountants with an AI server farm, they don't need 500 desks. They need a small server room in a basement somewhere. The demand for office space isn't coming back. It is structurally gone forever. This means the commercial real estate crash isn't a cycle. It's a paradigm shift. And the banks holding those loans are betting on a recovery that will never arrive. Okay, breathe. I know this is heavy, but panic is not a strategy. I didn't make this video to scare you into paralysis. I made it to scare you into action. If history is repeating, then we know what happens next. There is a flush, a massive transfer of wealth from the unprepared to the prepared. The people who got rich in 2009 weren't the ones who panicked. They were the ones who had cash when everyone else had debt. If you want to be on the receiving end of that transfer in 2026, you need a protocol. You need to stop acting like a consumer and start acting like a liquidator. Here is exactly what I am doing right now. This is my personal playbook. Rule number 1. Build the liquidity shield. Cash is trash during inflation, but cash is king during a crash. When asset prices plummet by 40%, the person with liquid cash gets to buy dynastic wealth for pennies on the dollar. I have stopped investing in the general stock market right now. I am not buying the S&P 500 at all-time highs while the PE ratios are screaming bubble. I am hoarding cash in short-term government treasuries and high-yield savings accounts. I want ammunition. I want dry powder. When the liquidity crunch hits, people will be forced to sell their assets to pay their bills. They will sell their Rolexes, their rental properties, their stocks. I want to be the buyer standing there with a suitcase of cash. You cannot take advantage of a crisis if you are fully invested. You need to be liquid. Rule number 2. Destroy toxic liabilities. If you have variable rate debt in 2026, you are swimming with weights tied to your ankles right before a tsunami hits. I'm talking about credit card debt. I'm talking about adjustable rate mortgages. I'm talking about car loans. When the credit freeze happens, banks will panic. They will look for ways to squeeze cash out of you. They will jack up interest rates on variable debt. They will lower your credit limits. You need to go scorched earth on this debt right now. Sell the stupid car. Cancel the subscriptions you don't need. Stop eating out. Use the snowball method or the avalanche method. I don't care which one, just get it to zero. You need to be lean when the storm hits. You need to be able to survive for 6 months without a paycheck if the credit markets freeze and your job disappears. Rule number 3, become indispensable. When the credit crunch hits, layoffs follow. It's happening already. But here is the brutal truth. Layoffs are not random. Companies fire the nice-to-haves first. They keep the need-to-haves. Now is not the time to quiet quit. Now is not the time to complain about returning to the office. Now is the time to make sure your boss knows that if they fire you, the company loses money. You need to attach yourself to the revenue line. If you are in sales, you are safer than if you are in HR. If you are in operations, you are safer than middle management. Audit your own job. If you disappeared tomorrow, would the company lose money immediately? If the answer is no, you are vulnerable. Fix that. Rule number 4, the safe haven allocation. While I am mostly in cash, I am also looking at the only asset that has no counterparty risk: gold. Central banks around the world, China, Russia, India, are buying gold at record paces. Why? Because they know the debt bubble is unsustainable. They know the US dollar is being devalued to pay off the debts. I am not saying put 100% of your money in gold. I am not a gold bug. But having 5% to 10% of your net worth in something that cannot be printed by a politician and cannot be defaulted on by a bank is simply insurance. It is the fire extinguisher in your kitchen. You hope you never use it, but you are an idiot if you don't have one. The hardest part of investing isn't the math. It's the psychology. It's standing alone when the herd is running in the other direction. Everyone around you is acting like everything is fine. They are buying things they can't afford to impress people they don't like, financed by banks that are secretly insolvent. They are dancing on the deck of the Titanic because the band is still playing. It feels crazy to be the only one preparing. I feel crazy right now making this video. I feel like the guy on the street corner with the end is nigh sign. But history has a funny way of rewarding the crazy ones who saw the pattern before the crowd. The wave is coming. You have seen the data. You have seen the charts. But more importantly, you feel it in your gut, that feeling that something just isn't right with the economy in 2026. You have 2 choices now. You can close this video, go back to scrolling TikTok, and hope the mainstream media is telling the truth this time. You can hope that the banks will figure it out and the government will save you. Or you can start building your ark. I'm building mine. I am stacking cash. I am clearing debt. I am sharpening my skills. But what if you don't have a pile of cash to protect? What if you are watching this and you are already starting from zero? Then you don't need a shield. You need a sword. If I woke up tomorrow with $0 in my bank account in 2026, I wouldn't buy gold, and I wouldn't worry about the crash. I would follow a completely different, aggressive protocol to get my first $100,000 fast, regardless of what the economy does. I broke down that exact step-by-step roadmap in this video right here. Click it to see exactly how I would rebuild from scratch, and I'll see you there.